Hi everyone, so today we're going to be talking about direct listings, and this is an alternative for private companies to sell shares to the public markets by bypassing the underwriting process and selling the shares themselves to the market. And this is an important topic in early 2018 as Spotify, the music streaming company, is considering doing and completing a multi-billion-dollar direct listing, the largest ever direct listing completed on the New York Stock Exchange. And this could signal a huge change in the underwriting industry if successful and able to really drive down costs for the issuing company. So this is an incredibly important topic. So, a direct listing, also known as a direct public offering, is a way for companies to be listed on a public market by directly selling shares outside of a traditional offering to investors. Usually, the issuing company registers with a designated exchange and puts up the securities for sale to accredited and non-accredited investors after advertising the direct public offering to the market. The shares are priced by the issuing company without the help of investment bankers and sold with the assistance of a commission broker. The issue is closed when all securities offered have been sold or the selling period has been closed. And the important note to take away from here is that the company needs to register with designated exchanges. Now, in the example of Spotify, which I don't want it to be specific to Spotify this video, but it's very important because Spotify is signaling a change in the underwriting industry. The thing with Spotify is that they're asking the New York Stock Exchange to change the rules because traditionally DPOs have only been completed on the NASDAQ exchange in the OTC market. So if the rules are changed and the DPO is successful on the New York Stock Exchange, this could encourage more larger companies to consider direct listing route. Now, one of the earliest and most notable DPOs was in 1984 when Ben & Jerry's ice cream raised $750,000 within the year to fund operations. The founders advertised their ownership stakes through local newspapers for $10.50 per share with a minimum number of 12 shares per investor. The offering was completed in the OTC market, as I said before. And so really, the direct listing has always been an alternative option for small to mid-market companies. Because with mid-market companies, when you're considering a $2 to $3 million total listing fee with the lawyer fees and the underwriters that you need to pay and all that, that can be quite costly if your market cap is, say, $20 million, right? So an alternative is the direct listing route, which allows you to just sell shares into the market. The problem is that you're responsible for selling those shares. You have to generate the demand. You have to work alongside a commission broker to execute the sale of your shares. But if you can do that, then it can be a very successful option and profitable option because you'll be saving a lot of money. Now, the traditional route is the IPO route. Traditionally, companies have employed the services of investment banks known as underwriters to complete an initial public offering, an IPO. Now, in this process, the bankers assess the company and determine a valuation while preparing management for a roadshow. And that roadshow is where the management team and their underwriters together go to different investment funds and they sit down and generate demand. That's one of the big responsibilities of an underwriter, to generate demand for an issue. Now, once the valuation is completed, the bankers and the management team of the issuing company meet with various investors and potential shareholders to sell the company and determine the demand for the IPO. Through various interactions with investment funds, the book building process is completed and the price for the shares of the IPO is determined. And I've made a separate video on the book building process. If you're interested in that, check my channel for that. But just a quick summary, the book building process essentially is determining a valuation range through technical analysis and evaluation of the company, and then going on the roadshow and asking investors, well, based on this range, where would you kind of find yourself? Would you pay a price of X or a price of Y? And through these different interactions, you really determine an ideal price to price the IPO at. And this is really important. The key to a successful IPO is determining the appropriate price because you're selling to investors. If it's overpriced, then probably you're not going to raise enough money and the money that you intended to raise. Now, if it's underpriced, you're leaving money on the table as the issuing company because you probably could have raised the price of those shares and raised more money and diluted the same amount of shareholders. So it's really important, and that's one of the key reasons why book building and the underwriting process is very important. Now, on the day of the IPO, the number of shares to be issued publicly are held by the underwriters. Once the market opens, a series of buy orders are placed almost instantly by the various investors that want to purchase shares, with the major orders usually coming from funds previously pitched to on the roadshow. Now, based on the amount of demand, the market price jumps or falls from the initial offering price, usually jumps, especially in very popular IPOs. Now, this process can be lucrative for underwriters, as in most cases, a bought deal means that the investment bank buys the full issue of shares from the company just below the IPO price, realizing a spread. As the shares are quickly sold off, the bank can carefully control market demand to support the trading price. So in the modern underwriting market, bought deals are the most common way to complete an IPO. And that's where the underwriter completes the analysis, goes on the roadshow, determines the valuation of the IPO issue, and then buys all of those shares from the issuing company, whether it's in a syndicate or just a single underwriter. And then they are now responsible for selling those shares. Now they buy it just below the IPO price, and after which they can sell those shares in the open market. And if the shares jump in value, then they can realize an even more profit on the shares that they hold on the balance sheet. So it's very, very profitable for investment banks. And that's why this direct listing is a threat to that, because much of the investment banking business is dependent on the fees from the underwriting process, a very lucrative process. So with IPOs, issuers, bankers, and investors in the past few decades have created a well-defined process of execution. This process establishes a strong group of well-informed initial investors and lists the stock for trading following a period of price discovery. Bankers and the issuer build demand for the stock that may be unsatisfied by the IPO itself, which is done through market making. Ultimately, with the IPO process, a company expects clear visibility and demand generation with follow-on coverage from equity research analysts. And so talking about the follow-on coverage, one of the important aspects, the follow-on aspects of the IPO process is at the moment that the company lists publicly, there's coverage. So there's different equity research reports that are completed. Now, there is a hold period, like a wait period, where the underwriter and their equity analyst can't write for the company. But after which, those equity analysts for that company will constantly write. And usually they'll write fairly positive reviews for the company in order to generate more trading fees for the business and at the same time help the company grow in value. So that's another important aspect of the IPO process. Now, historically, developed exchanges like the New York Stock Exchange and the Toronto Stock Exchange have been reluctant to list companies outside of an IPO for concern that there would not be sufficient liquidity, which is related to demand generation, and efficient trading of the securities, which is related to the market making absence that usually is produced through the IPO process of investment banks. So that's why this change and this push to really enact rules that will allow a direct listing by Spotify, a big company, can signal a huge change in the underwriting process. So what are the benefits of a direct listing? Well, with a direct listing, the issuance is much cheaper as the company directly sells the shares to the public and does not use an underwriter. They use a commission broker, which is executing the actual sale of those shares, but they don't have to pay fees for the roadshow. They don't have to pay fees for the book building process. They don't have to pay fees for the market making and the demand generation and the distribution ability of the underwriter. Now, that can be a negative, especially for small companies that need that demand generation and market liquidity. But for a popular company like Spotify, they already have that. So for them, they're just looking to reduce costs. At the same time, a huge one is there is no lockup period based on existing rules in early 2018. So usually there's a lockup period for insiders between 90 to 180 days after the IPO, in which me as a manager or a senior executive for Spotify would be unable to sell my shares. Now with a direct listing, I can do it on market open because traditionally I am selling my own shares. There's also no limit to the secondary offering of existing shares. Traditionally, no new shares are issued, thus eliminating any shareholder dilution. So what this means is that usually in an IPO process, the issuing company issues more new shares, and rather than selling existing shares, because traditionally the market is not very receptive to providing liquidity for exiting shareholder. They want to provide money to fund business operations, and that's done by raising capital through new shares that are issued rather than existing shares that are sold, and thus the money goes to the selling shareholder. Well, with a direct listing, there's no limit on that, and traditionally direct listings have been 100% existing shares. So 100% of the proceeds have gone to providing liquidity for selling shareholders. Now, in addition, the company does not have to go on an expensive roadshow. It controls the sale of its shares, and this is again essential. Underwriting fees can go into the millions, hundreds of millions for billion-dollar companies as well. And why? Why should they? If you can reduce your costs, the direct listing can be an option. Now, what are the risks with direct listing? Well, the problem with a direct listing is, one, the company does not benefit from the well-defined IPO process with professional support by investment bankers, as I talked about, the demand generation, the liquidity support through market making, the follow-on coverage, all of that's not offered. However, again, you have to ask yourself, will that follow anyways, seeing that you are a big company? In addition, there is no buffer against volatility, usually avoided through the market making of designated underwriters. So on the first day, when the stock is quite volatile, whether it's jumping up or down, an underwriter can really provide market support for that share price by slowly selling off shares or controlling the market price by being that market maker. So that's an important function on the first day. In addition, there's no green shoe option available to accommodate increased demand. Now, the green shoe option traditionally in an underwriting agreement is where the underwriters, if they see that there's so much demand for this new issue on the first day, are able to sell an additional 15% shares or 15 or 20% more shares in order to raise even more money. But with a direct listing, the amount of shares that you sell into the market are the amount of shares that you can sell into the market, because you're not going to be issuing new shares. And at the same time, there's no presentation support from professional advisors. And I like this because I think this is important for small to medium-sized companies. Similar to investment banking advisors, sometimes companies say, oh, well, why do I need an investment banking advisor? I can just sell the company myself. Well, no, the key to having professional advisors is helping you shape your story and help you understand the step-by-step process that it takes from going to point A to point B, which is point A private, to point B, which is public. So these are the risks. Now, let's look at the direct listing process. All of the business preparation, due diligence, prospectus drafting, securities and exchange engagement, and oversight are part of the direct listing process, and the forms required for such a listing are substantially the same as those required for an IPO filing. So it's very similar to an IPO filing. The only real obstacle a direct listing avoids is a 2-week roadshow that management uses in an IPO to meet with investors and tell a story. Now, the question is, could you do that yourself without advisors? Could you set up those meetings by yourself? Well, it depends. Again, if you have those relationships, if your CFO has come from, the finance industry, he probably already has those relationships. So it's not a real problem. But in a scenario where you don't have those relationships, then yes, you bypass that. Now, certain items in the forms, such as capitalization, dilution, and use of proceeds, won't be applicable in a direct listing process. Because remember, you don't have to state your use of proceeds, because traditionally, DPOs have been selling only the shares that are held by existing shareholders. So what existing shareholders do with those proceeds are none of your business, right? Whereas if you were to sell new shares, as traditionally is done in an IPO, well, you need to communicate to shareholders, oh, well, this is what we're going to do with the money that you've given us. Now, the registration statement is still subject to a SEC comment letter review process, and a direct listing can't be declared effective without SEC approval, which is exactly the same to an IPO process. And so that's where Spotify finds itself early on in January 2018. Now, once approved, the company merely makes existing shares available on an exchange so they can be traded. So one of the first questions I thought when I was reading about direct listings, and I was like, well, this sounds like a really good idea. But then I think, well, what do you give up when you move away from the IPO process? Well, the first one is the roadshow. So is a roadshow really needed? Well, one of the key benefits of engaging in an IPO with an experienced underwriter is the existing institutional relationships that this team can provide. By setting up meetings and interviews with key investors, the underwriter can help the company generate demand for its issue and say the right things in front of the right people. But is this demand generation needed for large companies who have an established brand, knowledgeable customer base, and a capable management team with existing institutional relationships? The answer is most likely no. The roadshow is a convenient way to generate demand, but not the only one. And again, I'll say this, I've already repeated it once, for small to mid-market companies, I think a roadshow is absolutely needed. You need to go down that road. But if you are Spotify, if you are, I was having this discussion with one of my colleagues, and we were talking about Saudi Aramco. And, he was very supportive of the IPO process. He didn't really like the direct listing process. He's like, well, what about Saudi Aramco? Would it make sense for them to do an IPO, a direct listing way? And I'm like, no, because there's a lot of distribution challenges there. When it talks about roadshows are traditionally focused on generating demand and establishing, these key funds that are most likely going to hold on to large swaths of your stock. And, you have these long-term holders. Now, with a extremely historical issue like Saudi Aramco, you're probably not going to benefit from doing it on your own and just going on your own and trying to set up these meetings. But if you are a relatively large company, very well known, then you're probably going to do well. The thing is, it's that makeup. Like when you think about the percentage of institutional versus retail holders, traditionally, successful IPOs, there's a large institutional holding base with a smaller retail holding base. Now, if you were to bypass the roadshow and just go the direct listing route, I don't know. I wouldn't. No, it's new. That's the thing. That's the problem with this change. It's gonna be interesting to see the percentage of holdings of retail investors versus institutional investors, because a roadshow encourages institutional holdings. But I still think that institutional investors would want to buy into the company, and therefore there'll still be a strong presence of institutional investors. So again, it's an interesting thing. That's why I really am interested in what's going to happen. So the key question then is, what do you miss by skipping an IPO? Well, to begin with, there are 3 reasons why a company pursues an IPO. Well, one is, of course, to raise money by issuing new shares, from Treasury to fund operations. 2, to provide liquidity for existing stakeholders to sell shares. But remember, there's a lockup period, which does exist, between 90 and 100 days, and usually only 20 to 30% of the issue is used for this. And then 3, it's to create acquisition currency that can help finance stock mergers in the future, so M&A. Now, these 3 reasons are provided by many people who have written against direct listings in the past few months. Well, let's actually look at these 3 things and ask ourselves, do we miss anything by going the direct listing route? Well, in my opinion, you don't really miss out on a lot of things. Firstly, with a direct listing, there is no lockup period, and all shares in the issue can come from existing shareholders rather than Treasury. The problem is that investors tend to frown when they give money to exiting shareholders rather than funding operations. The real challenge is it's a trust problem. There's no rule limiting that company from doing 100% treasury or 100% secondary offering. That's the thing. The company has complete discretion as to how they want to raise money and issue shares to the market. It's their direct listing. They control the selling of shares. So if they want to sell 100% of existing shares, do it. If they want to do 80-20, selling 80% of existing shares and 20% new shares, do it. It gives the company much more control, which is a good thing. Now, second, however, if a company wants to issue new shares to use some of its proceeds to fund operations, they can with no limitations. And at the same time, they have no lockup period. So for internal shareholders, maybe shareholders that are looking to exit a company, that can be a good thing. Now, with regards to M&A, in a scenario where the company wants to use shares as acquisition currency, it can simply complete a secondary equity offering and issue more. So while in a scenario where you have a company that sells 100% secondary, so all existing shares are really sold to the market, Well, if the company later on wants to really get into an acquisition with another company, a stock merger, they can simply issue more shares and they just sell more shares. That's the thing. Like, there's no real limitations to skipping out on the IPO. Again, it's the convenience of the IPO, it's the well-defined process, and it's the establishment. And this is a threat to the establishment, and I think a very interesting threat. Now, let's look at the existing direct listings. Now, based on the direct listings completed in the past decade, the life sciences sector has been the most popular user of this funding source. In these cases, funding rounds were previously completed and then the shares were sold publicly before being listed on the NASDAQ or the OTC. Now, no DPO has been completed on the New York Stock Exchange as proposed for Spotify, and at the same time, not a law has been raised. So these are really the most common ones. There's probably less than 20 DPOs, serious DPOs around the $10 million range. Now, Nexion Med Systems, Fortress Biotech, and Nova Science, they raised 10 million, 25, and 35. Now, it's interesting to see, their performance. The listing price was at $2 a share, and now it's at $1. So this one really underperformed. This company did very well because they issued at 10. They're at a lower price today, but they followed on and sold more shares later on because they wanted to and they're doing well. And so they raised 25, but their market cap today is actually 212 million. So they actually grew a lot. And then Nova Science as well, they sold at $8. The current price is $1.27, but they actually sold on more shares, and their present market cap is 45 million rather than the 35 initially. So there's still, again, a lot of positives to this, but again, the problem is there's no precedent to a $1 billion issue. So it'll be interesting to see what happens. So as I said, the Spotify revolution is really why I'm so interested in the direct listing option. So on January 3rd, 2018, Swedish streaming giant Spotify has filed to go public sometime in 2018 by submitting an F-1 document for clearance by the Securities Exchange Commission. Assisted by Goldman Sachs, Morgan Stanley, and Allen & Co., the company is the largest company ever to consider a direct listing with a valuation of $20 billion. For the first time, the New York Stock Exchange is changing its rules to accommodate the direct listing, and it will be an important move signaling a potential change in the underwriting business. Now, again, this is beautiful to me. Okay, so who would handle Spotify's underwriting if they were to go to the traditional IPO route? Goldman Sachs, Morgan Stanley, and maybe another one, and probably Allen Co. later on in the distribution list. So it's the same guys doing the same thing, except that now they're only going to be acting as commission brokers and really selling the shares rather than helping them and offering their distribution system and all that kind of stuff. So there's no comment because, again, the direct listing has not been executed, so we're not sure how much Spotify will be paying. But if they will be paying less than they will be paying for a traditional IPO and it's successful, this could be a huge move. So firstly, let's talk about the argument for Spotify's direct listing. So as a major company, an IPO will cost tens of millions of dollars to complete for a valuation in the range of $20 billion. Consider last year's, so in 2017, Snapchat issued $3.4 billion in shares, and they raised that at a total valuation of $24 billion, which cost them around $85 million in fees for the underwriting fees. For a company like Spotify, that has not been profitable yet, and with a pending $1.6 billion lawsuit, the company needs to consider costs highly. And when you think about that $85 million fee, if you can save even half of that, that's a huge cost saving. And you probably can save more than half, especially if you go down to direct listing route. In addition, it is important to consider the mixture of treasury and secondary shares. So again, with a direct listing, you can just go 100% secondary if you want. Now, last year, Spotify sold to TPG and Dragoneer Investment Group convertible notes that reportedly carried a provision that lowered the conversion price with each passing quarter that the company remained private. Now, this is a special scenario, and I don't understand how the company agreed to such a convertible note, because it's bananas to me to think that you would put yourself in this corner. But really, it's the perfect storm for Spotify to really push down the direct listing route, because for them, they know that TPG and Dragoneer are going to convert this note into equity in the future. So there is going to be this future pending equity dilution that will happen. So they're trying to avoid as much dilution now when they go into the public markets, so that later when this dilution does happen, it doesn't extremely dilute shareholders, it just dilutes shareholders, right? So it's a very special scenario, but again, it shows you why Spotify wants to do this. Spotify is in this scenario where they have money, they raise money from this convertible note, but they know that this convertible note will dilute them, so they want to go to the public markets without diluting the existing shareholder base in expectation of a future dilution. So the argument against Spotify is that theoretically, trust is an important factor in the IPO market, and the process is designed to make it easier for big, long-hold funds to buy into the stock. Companies want their stocks in safe hands, aka the funds that have a long-term view and won't puke it up at the first earnings miss. Now, management usually also communicates with the institutional owners, leveraging their expertise and perspective when discussing macro strategies. These relationships are traditionally started when they first meet on the roadshow. So I think this is the biggest loss, because for me, the execution, the actual sale of shares is not difficult. You can hire a commission broker and save a lot of money. The problem is relationships. The problem is trust. And I think, again, with retail investors, yes, if you have a higher percentage of retail investors holding your stock, then it's probably going to be more volatile in volume, because, again, those retail investors don't really understand the long term. Now, you can argue against that as well, but I think that that's an important point against Spotify's direct listing route. And at the same time, when you meet new institutional investors, you meet them on the roadshow, and that could be a big miss for Spotify. Big funds also like to invest in IPOs because they can get a starter position via share allocation and then buy in the open market to get a full position size with a lower average cost than if the position was built fully through open market purchases. Beyond that, the actual pricing of shares is more controlled with underwriters, which ensures less volatility. So another big argument against Spotify's direct listing route is that with IPOs, traditionally the big funds, that's why there's always this big pop, because funds expect to, invest 2% of their fund. And if they have 2% of, how many billion, that can be a large amount of volume. And to acquire those shares is going to take a long time. So if you can get in early on via the share allocation, you can build that position much more quickly and at a lower cost. The thing is, though, if you're with a direct listing and you use a commission broker, I think you can still do that. That's not missed out. It's just that the communication is going to be a problem. And again, trust. Will the funds be there when you actually want to sell shares? So that's the issue. Now, again, when I talk about the IPO business, I think that a lot of people have a negative perspective of it, especially once they leave, because it can be quite corrupted. So I think it's first important to understand two important different pricing levels. So there's the offering price, which is the IPO price that is marketed to the public by the company and is initially determined by the book building process. And then there's the opening price, which is the price of the issue once trading begins, depending on the amount of demand for shares. So your offering price, you can't really buy in the offering price as a retail investor. But the opening price is the price usually after the pop, right? And this difference between the two prices can range erratically, with some cases, especially during the dot-com boom, jumping by 150%, and it's completely different. So the problem is that the issuing company can't participate in this upside. If the shares are undervalued and therefore there is such a significant pop, the only really participant in this market that benefits right now is the underwriter, right? So the IPO business is largely controlled by the underwriters and the establishment, and it's really put in favor of the investment banks to generate fees and really to make money off the issuing, which is sad because at the end of the day, the company should be controlling the process because it's the company's shares. The company is the one who's actually creating value. Really, the investment banks and really the IPO process is there to extract value, extract as much fees as you can. And that's why some people argue that it can be corrupted. So some industry observers argue that the existing system is skewed heavily to favor the underwriters and their favored clients. Theoretically, bankers should aim to equalize the offering price with the opening price to prove that the shares were correctly priced at existing demand. A negative spread would mean the shares were overpriced, while a positive spread means that they were undervalued and money was left on the table. And we can talk about the downside. So if they were overpriced and therefore the price fell after the opening price is less than the offering price, people will be like, oh, well, then the underwriters would suffer because they'd have less valuable stock on their books. Traditionally, that's not the case, because most of the time, because the underwriters have such a strong distribution process, they don't shove that stock into institutional hands. They then invest it and push it into the retail hands, the guys who actually don't understand the issue that much. And it's kind of taking advantage of retail investors. But a great way to really determine if an IPO is successful or not is to look at the mixture of institutional and retail holdings. If institutional holdings is a higher percentage than a retail, then traditionally that should be considered a good issue, because there's strong demand from institutional. But say, for example, 20% institutional holdings, 10%, and the rest is retail holdings, that's a bad issue. Something happened there. Institutional investors, which are considered the smart money, are out of it. They don't want to be involved, and probably the opening price is below the offering price, and therefore the underwriters just shoved all that stock into retail hands just to get it off their books, and again, not lose money. So it is quite corrupted. Now, few investors can buy at the IPO price, at the offering price, because most shares go to the underwriter's best institutional clients, and some are reserved for the company's friends and family. So most investors' only option is to buy in the open market when the shares start trading. This usually drives up the price aggressively if demand is high enough. This favoritism is a major argument against IPOs. Secondly, the incentives for underwriters are questionable. When money is left on the table, and thus the IPO price pops on the initial trading date, the offering company does not benefit from the increase, but the underwriters do, who start selling the shares they hold from the bought deal. In addition, the increased trading volume and fees related to the issuance further accrue to the banks. In reverse, when the IPO is overpriced, the banks stuff retail clients with a bad holding. So, in conclusion, the direct listing process is an alternative route to consider when issuing shares to the public market for companies that meet a prerequisite size determined by the targeted exchange. And so in this case of Spotify, if the rules are approved. It is an effective way to provide liquidity for existing shareholders, as usually no new shares are offered in the issue, and there are no lockup provisions, providing a lot of liquidity for exiting shareholders. By bypassing the predefined IPO process, however, certain liquidity and demand building challenges do arise that need to be considered. In addition, building relationships with institutional investors remains an important factor of success, which cannot be avoided. In the case of Spotify, because it's a large company, people are still going to talk to them, but for smaller companies, if they bypass the IPO route, they can put at risk the potential institutional relationships that they avoided. So that's really important to understand. So again, you can save money and you can do it yourself if you're a big company and you have existing relationships. But if you're a small company, it's better still to go the IPO route and pay the fees. So other than that, thank you so much for watching. If you have any questions, please do comment below. I'll be sure to comment once Spotify does come on. This should be in late 2018. I'll put a comment saying, what fees they ended up paying, just to show you. I expect them to pay about half of what Snapchat paid. So if it's less than $40 million, this is a huge step forward in the underwriting process to drive down fees. If they still somehow pay high fees, then the direct listing route is probably not the best option, and therefore just stick to the IPO route. As always, if you have any questions, comment below, and if you did like the video, please like and subscribe to the channel for more. I appreciate all the support, and if you want to message me privately, you can just send me an email as well. Other than that, guys, thank you so much and have a great day. Thanks.